This is Jim Lee of Strategic Foresight Investments, and I'm here to walk you through our market strategy for the second half of 2018. This is a chart of the S&P 500 index, and after a sharp correction end of January, beginning of February, stock sort of stabilized and went into rebound mode in April, and they've been trending upwards ever since within this channel. I would say that for the time being, we're range bound with short-term targets over the course of the next month or two at the 2850 level, with downside quite possible down to 2720. Now you're going to see some confirmation of this trend here with the on-balance volume. And this would suggest that we might be breaking out of this all-time high of the market by year end, which would put us right up around 3,000, and that would give us another 5% upside for stocks over the course of the next 6 months or so. Now, when we take a look at the market map, you get a better sense of what we call breadth of the market. Good breadth is when a lot of stocks are participating in a rally. Bad breadth is when very few stocks are. So it's fairly easy to read. Green is good, red is bad. And for the first half of this year, just 4 companies, Amazon, Microsoft, Apple, and Netflix, contributed 80% of the upside for the S&P 500. So if you didn't own these growth stocks, the chances are good that you weren't making a lot of money. And I do see a little bit of cross-dressing involved here. Amazon has been almost entirely responsible for driving gains in the retail sector, while Apple is considered now to be a consumer goods company. So technology stocks are leading the market even when they're not classified as technology. Lots of questions these days about the current trade dispute with China. And keep in mind that it's not necessarily about tariffs, but also the treatment of intellectual property and access to foreign markets. And the truth is that nobody wins in a trade war. Prices go up for everyone, and entire industries are being hurt in the process. That being said, the U.S. does seem to have the upper hand here. If you take a look at it, the Shanghai Composite Index in green is now in a full-out bear market with a 22% decline since its peak in January. You'll also see that the U.S. and the Chinese markets really disconnected with each other beginning last month. One is regaining momentum while the other has fallen apart. And I'm still a fan of a lot of Chinese stocks such as Noah, Tencent, and Alibaba, all of which are looking comparatively cheap right now. And at some point, maybe not quite yet, but at some point there's going to be a nice rebound here. So in summary, we're still in a bull market. I don't see much need to have a lot of bonds or cash right now. Technology is still leading the charge in terms of earnings growth, but I'd also like to take a look at some genomics companies at this point. This is being featured right now within our sector rotation strategy. Really could be the next big thing. Meanwhile, it's a good idea to put together a shopping list for your favorite China growth stocks, but maybe wait until we see some better momentum. Longer term, as in the second half of 2019, we might want to get a little bit more defensive and start looking at some market neutral strategies. So thanks again for your time and interest. If you have any questions, feel free to call or send an email to jlee@stratfi.com.